Good evening, everyone. Hello, Mr. Conlon. First of all, thank you for braving the elements and coming out tonight to be with us for a little while. I think we may have lost a few people to the weather. A couple of people packed it in, and I don't blame them. Certainly appreciative that you all made it. My name is Mike Furtick. I know many of you here. For those who I haven't met yet, I'll look forward to meeting you tonight or at one of these other events that we plan on holding throughout the year. Tonight's event, and first and foremost, I want to thank Kurt Carlson, who is just to our right, with MFS, who was really responsible for making our presenter available for this evening. And I wanted to, before I introduce the presenter, I wanted to just give you a quick background on the topic. The topic, of course, is Roth IRAs, and specifically conversions of Roth IRAs. And certainly, if you've listened to a news report or read a newspaper in the last couple of months, you can't get away from the coverage. People are making quite a big deal about this opportunity, but I think one of the things, a couple of the things that are really misunderstood are, first of all, that this is the beginning of an opportunity for this conversion. In prior years, there was a certain income limit. Many people weren't even eligible to do a conversion. Well, they've taken that away, and that will continue until they change the law again to be repealed. So this is just the beginning of the opportunity. If you don't do it in 2010, you can do it next year. You know, it isn't a use it this year or lose it type of a thing. The other thing that is kind of misunderstood is there a universal, I should do a Roth conversion, or I shouldn't do a Roth conversion? Well, the answer, and you will hear this evening, is it depends on an awful lot of things. And because every one of your situations is unique to you, we want to give you a general understanding and arm you with the appropriate knowledge so that you can begin thinking about whether or not this is something you want to discuss further. And you should discuss your specific situation with your advisor, who has access to some pretty sophisticated software that will help you to determine whether or not this is the right thing for you to do. Okay? So with that said, I'm really excited to present to you Doug Orton, who is also with MFS, been in the financial industry for about 2 decades, and more specifically over the last couple of years has really honed in on the Roth IRA subject. And so for the next 30 minutes or so, Doug will give you what I think is some pretty good information, and we'll have plenty of time for Q&A at the end, but certainly if you have a question as Doug is doing his presentation, I'm sure he'd be happy to entertain that as we go. Okay, so with that said, let me introduce Doug Orton.
Thanks a lot, I appreciate that. And I would like to stress that if you have a question as we go along, I think it's better if you ask it as you think about it. Because some of the topics we're going to talk about build on each other, and if you have a question and we don't address it, I think things can get lost in the end. And from my experience, if somebody in the audience has a question, there's probably 6 or 7 other people who have the same question. So I think it's better if we do it as we go. So when we think about the Roth conversion, you've started to see this in Money Magazine. You might have seen articles about it. They've been in the Journal. They've been in USA Today. And you start to think about what this could mean for your retirement or for the legacy that you might leave to the next generation. And the first thing I would say is I would think about this a little bit broader. Because really what we're concerned about isn't really the Roth. It's that we want to generate enough spendable income to support you and your family's lifestyle for as long as you need it. For some people, the Roth conversion will make it more likely to be successful. And for some people, a Roth conversion would make that less likely. So what we're going to talk about today, first I want to explain how the Roth works. Because Roths work very, very differently than any other retirement plan we have. And so that causes a significant amount of conversion. So we'll talk about the Roth rules in general. Then we're going to talk about the pros and the cons of converting, how that's taxed, what you need to consider. And then we're going to talk about the things that you're going to want to consider when you talk to your advisor about whether you should convert or not convert, or I would say more accurately, how much you should convert. Because one of the things that drives me absolutely crazy when I see articles about the Roth or hear somebody talk about it on the radio is it's always discussed about should you or should you not, as if this is an all or nothing deal. And it isn't. You can convert all of your account, you could convert none, you could convert 3%, 30%, anything in between. And when you think about it that way, it becomes a much richer opportunity. So first, how does the Roth work? The key to understanding the Roth is to understand how money comes out of the Roth, which is the exact opposite of all other retirement plans, in that your most tax-advantaged money comes out first. The first dollar you take out of your Roth, if you have any regular Roth contributions, that money comes out first. It is always tax-free. It is always penalty-free. So that regular $5,000 contribution, if you're eligible to make that, you take it out the next day. Regardless of age or reason, that is going to be tax and penalty free. Makes it a very interesting thing to use with some strategies we might have time for at the end. Second piece of money to come out would be your converted amounts. And they come out in order, oldest first. Now when you withdraw a conversion, it is always tax-free because you're going to pay taxes on a conversion when you make it. So if I have $100,000 in my traditional, I move that to the Roth, it's going to generate taxable income, and we're going to talk about how that works. But because I've already paid taxes on it, when I pull that money out, it's not taxed again. And it won't be penalized if you meet one of two tests. Either that conversion has to be older than 5 years, though your clock starts on January 1st of the year you do the conversion, or you meet one of the other exceptions to the 10% penalty that you might be familiar with from traditional IRAs and 401ks. This is the biggest thing that I think people get confused on, is that people think you have to meet both. So where it becomes important is if you're looking at a conversion and you're already above 59.5, that converted amount will always be tax and penalty free if you want to pull it out. The last bit of money to come out are your earnings. And those will be tax-free if you meet two tests. You have to meet both. You have to have opened a Roth somewhere more than 5 years ago. It doesn't have to be the Roth you're making a withdrawal from. Any Roth anywhere starts that clock. And you have to be either 59.5, dead, disabled, or a first-time home buyer with that weird definition that the IRS has of a first-time home buyer. If you meet both of those, your earnings come out tax and penalty free as well. And I think that's one of the reasons people get confused is there's two 5-year clocks. They work on different amounts. They work in different ways. It can be confusing, but what I would remember is if you use the Roth the way Congress intended, you put money in, you'll leave it there for a decent length of time, let's say 5 years, and you take it out after retirement age, everything is tax and penalty free coming out. That's the big advantage of the Roth is tax-free growth is good. Tax-free income is good.